all I'm reading about recently is 0-day options. Can you just explain what I need to know about this and whether it's something that can impact our trading? Now, you're right, there's been a lot of hype about this recently, and I mean, rightly so, because the amount of volume that these options are estimated to have is quite high. Now, for those who are not aware or don't know what it is, zero DTE or 0-day options simply refers to options contracts that expire in 24 hours. Now, usually options contracts had a weekly or a monthly expiry, but 0-day options expire in a day's time. So it allows for a lot more, flexibility and directional bets, especially on big data days, and also allows high frequency traders to do a lot of creative things, whether hedging, or with directional bets. For example, if you're sitting on a big desk, with some high frequency traders, they can take many small directional bets, to try and stay under the radar. Now, that's a good thing about it. What it has also done, though, which is a little bit bad, is that it's made it far easier for the retail trader to gamble, with options. Now, even though the media is always, blaming the retail crowd, there has been some estimates by, I believe it was by Nomura, JP Morgan, and RBC, that said that the vast majority of the activity is on the institutional side, with only close to, I think, 6% of the volume really related to retail traders. So it's not, it's when you look at the volumes that these things have done, it's quite staggering. I think it's about 40%. I think Goldman estimated that it makes up about 40% of the S&P's total option volume, which is staggering. But only 6% of that is retail. The rest is all institutional. So for many, that means that it opens up the risk that moves that might have only been, let's say, a 1% move might end up being something like a 2 or a 3% move or greater, because the flows can exacerbate or can be exacerbated by these, zero DTE options. Now, there's really two sides to this frenzy right now, from what I can see. Those that say it's very bad and it could lead to really big losses and a possible, volatility event, if you will. And those that say, hey, you know what, it's not a big deal. It's actually quite okay. Now, for those that are concerned, they say that these options are dangerous, or at least their volume is dangerous, because they're suppressing volatility, which, according to some participants, is dangerous because markets could be sleepwalking into a big volatility event. Now, the reason given for this is mainly due to the role that options dealers or market makers play in this game. So you have a trader, let's say you have a trader who buys a 0-day option call in a security. And that call needs to be balanced on the market maker's books, right? On the options dealer's books. So since they sold the call to the trader, they now need to buy the underlying when that security starts to go up. So let's go to a chart. Let me just explain this in a bit more detail. So let's just look at this, what we just said. So imagine you have a stock trading at, let's just say the stock is trading at $10, right? You have a stock trading at a security trading at $10, and you have a trader that buys an out of money call option, a 0 DTE call option, with a strike price of, let's just say, $13. Okay, so it's far out of the money. Now, imagine that the security, this stock, starts to go up and it reaches, let's just say it reaches up to $12. When that happens, the options dealer needs to increase their exposure to the underlying asset by buying the underlying asset, by actually buying the stock. Why? Because they sold the call option to the trader. So they need to balance out the books by buying the thing that's going up against them, if that makes sense. Now, that buying, when the price gets to 12, that buying by the options dealer or the market maker further pushes up the price. Now, imagine we hit $13 on the security, and then there's a bunch of calls being bought at, let's say, the $15 strike, right? So price is moving up, momentum is moving up. Now we see a lot of calls coming in for the 15 strike. And then imagine the price goes up to $14. Now we need to see that same dealer once again buying the underlying, because the price has gone up. And by buying the underlying, that pushes the price up even more. Now from 15, you see a lot of calls coming in, from with a strike price of 18. And now you see a lot of buying activity once again of the underlying by the broker or by the options dealer when price reaches 16 or 17. Now this is a very, you know, it's a very elementary example, but you get the idea of why some say this is dangerous. Is because of the way that these dealers need to balance their books. If you see, $1 trillion worth of stuff traded, if a very big volume gets traded on a specific underlying asset, and that thing needs to be continuously bought and continuously sold as more options, whether calls or puts, comes into the system, that can have a big snowball effect, and that can obviously, impact the markets negatively. Now, that is the concern for some out there from a volatility perspective. JP Morgan had a note out the other day that talked about this. Now, those that say it's not bad, as some think, that's the likes of Bank of America. They say it's because these options. Um, Now, what's interesting is that those that say it's bad and those that say it's good say that it's good and bad because it suppresses volatility. So the reason why some say it's bad is also the reason why some say it's good. Now, Bank of America, they say that it's not as bad as everybody thinks because these options are not all they're not all one-sided, and means that the risk of the markets, sleepwalking into a huge volatility event is unlikely, as there is plenty of mean reversion taking place with these options trades every single day. So these options are being used to place bets on, they're not being used to place massive one directional gigantic downside trades or upside trades, but rather used as a way to speculate on buying the dips, or maybe shorting intraday rips. So it's small. It's one day. You're not expecting a 10% move, for example. You're playing a very short time frame, which means that there's a lot of counter orders across the board, which means that it's more balanced. It's not the markets potentially sleepwalking into this horrific event. And as these options are rolled fairly quickly, the average holding time, I think, is about 6 hours. So even though it's certainly possible that we can have a huge volatility event in just 6 hours, it's not the same fear as voiced by those, because there's a lot of strong activity in both directions. Those that say, hey, it's a big volatility event, it can happen, of course, but that needs to happen when there isn't a lot of strong activity in both directions. And there's currently a lot of activity in both directions. So for those that say it's not so bad, the suppression in volatility is a good thing, because it means if we've seen a very big down day in equities, for example, and volatility is ramped higher as a result of it, then the 0-day option call buyers can actually suppress that volatility by buying the dip, and they would just be playing mean reversion. They won't be doing anything else. They would just be looking for an edge to either buy the dip or sell the rip. Now, in terms of what all of this means for us as traders, it means that we could see more two-way volatility with big risk events, which is, of course, a cause of concern, because that is really where I gravitate to in terms of the bulk of my trading. My biggest edge in trading is trading out of risk events. So if these things mean that there's a lot more two-way risk, then obviously that can pose some problems. The other area where it complicates trading is because there's so much two-way option activity going on. It does open up a lot of mixed messaging when it comes to volatility, especially when looking at things like the VIX. So that is a concern for some as well. But for now, I don't see myself changing the way that I trade out of risk events just yet, because I haven't seen this impacting the strong directional moves out of risk events by all that much. So a quick example would be, remember that massive day we had in the dollar on the 3rd of Feb with that NFP and that ISM. That was a day that we traded. We had a fantastic trade in the dollar that day with the NFP, with the ISM services that surprised so much to the upside. If 0-day options had this huge impact on two-way volatility, then we wouldn't have been able to trade that. We wouldn't have had any edge, because we wouldn't have had any real directional momentum, but we had very clear directional momentum to play, right? So for now, I don't see this as being a big problem. The other thing where it could be interesting, is if it's possible to get really high quality data sources for these option flows. And since we know that they tend to mean revert, it could actually be a really cool quant strategy to plot. To plot where the highest levels of activity is sitting around by looking for either continuation or mean reversion areas using the strike prices, the bigger volume strike prices. But again, that's outside my scope of expertise. I don't have the math skills to be able to do stuff like that. But that could be interesting. If you have the quant skills, then that could be something to consider. Finding really high value levels on the charts based on where the bulk of these traders are placing their bets. That could be interesting. Again, if you can get access to that data. But I think that's about all that you need to know about this. For now, I don't really see this impacting the way that we approach the markets. For now, there's still very strong directional plays that we can take out of key risk events. I don't see that changing anytime soon.